You are sitting in your perfectly functional living room, watching an hour of home renovation shows, and suddenly your kitchen looks like a total disaster. You look out the window and see the neighbor gutting their house for the third time. It creates this powerful illusion that everyone around you is building massive wealth through real estate. So you convince yourself that dropping tens of thousands of dollars on quartz countertops and a farmhouse sink is a smart, responsible investment in your property's value. But the data paints a very different picture. This chart shows a wealth breakdown where the median American has a net worth of $247,000, yet often lives paycheck to paycheck. That massive 70% slice represents net worth effectively frozen inside the walls of the house. Treating your house like an ATM to fund cosmetic upgrades is a guaranteed way to ensure you will be making mortgage payments until you are 75 years old. Let's trace the actual math on an average kitchen renovation, which right now runs about $26,000. Most people do not have $26,000 in extra cash sitting in a checking account, so they fund the project by taking out a home equity line of credit, or a HELOC. This flowchart shows how a HELOC works. You pull $26,000 of equity from your house, handing it to a bank. They loan it back, charging 9% interest to borrow your own money. This model systematically drains your personal wealth. Homeowners justify the drain because they think their paper net worth is rising. But home equity isn't actual money. You cannot eat it, and you certainly cannot take your brand new kitchen island to the grocery store to pay for your family's food. When you finance a cosmetic upgrade against your house, you are mathematically turning a depreciating consumer trend into an active, high-interest drain on your monthly cash flow. That $26,000 kitchen will look totally outdated in 10 years anyway, and when you eventually sell the house, you are almost never going to get a dollar-for-dollar return on that project. The real financial damage here lies in the opportunity cost. We have to look at what that exact monthly payment going to the bank could have achieved if you deployed it somewhere else. This graph tracks two paths. The bottom line is your kitchen remodel, stagnating and losing value. The top line tracks that same HELOC payment invested in an index fund. As compound interest takes over, it multiplies into hundreds of thousands of dollars. That $26,000 price tag masks a much larger sacrifice, the hundreds of thousands in compounding growth you've signed away to the bank. The unglamorous solution here requires you to be brutally honest with yourself about the difference between a want and a need. You absolutely have to maintain your physical property. Dead water heaters, ruptured pipes, and failing HVAC systems are mandatory, non-negotiable expenses of homeownership. Installing custom cabinets or a farmhouse sink qualifies as luxury consumption, pulling money away from your net worth rather than building it. If you truly want to upgrade a room in your house purely for the aesthetics, the golden rule is simple. You need to save the cash and pay for it outright. Financial freedom depends on liquid, income-producing assets, a sharp contrast to a highly updated home that keeps you tethered to a mortgage. Stop treating your primary residence like a piggy bank. True wealth is about making your money work for you,